Choosing an ETF than doing stock picking can be very helpful and stress-free for most investors, whenever if you're new or experienced. A study show average investors are underperforming the S&P 500. Trying to beat the market is not simple as people think. That's why building a portfolio with only ETF can be the good to build wealth over the long time. Before starting, let me remind you what's an ETF. An exchange-traded fund, ETF for short, is an investment fund that lets you buy a large basket of individual stocks or government and corporate bonds in one purchase. Now let's talk about the 4's ETF you need to have in your portfolio. VTI is tracking the CRSP US Total Market Index. That means it will track the performance of the US stock market, including large to small cap stocks. With VTI you will be well diversified. There is 4,100 stocks inside, and this ETF is very cheap, only 0.03% expense ratio. Another good point is the average 10-year return. If you have invested 10 years ago, you will have a yearly return about 12.52%. The top 8 holdings is constituted of Apple, Microsoft, Amazon, Google Class A, Tesla, Google Class B, the famous Berkshire Hathaway, and Johnson & Johnson. With these companies you can sleep like a baby and keep investing till your retirement. And with VTI you will get a dividend yield about 1.56% per year. The second ETF is VNQ, the Vanguard Real Estate ETF. VNQ is tracking the MSCI US Investable Market Real Estate 2550 Index. That means it will capture the return of all the real estate investment trust in the real estate sector of the stock market. With VNQ your money will be invested through 172 different REITs, from commercial buildings to industrial. The 10-year average return is 7.48%, but keep in mind investing in REITs are not for the growth but for the dividends. And the expense ratio is 0.12% per year, not so expensive, so it will be a good add to your portfolio. The top 8 holdings are Vanguard Real Estate Index Funds, American Tower, Prologis, Crown Castle, Equinix, Public Storage, Realty Income, and finally Welltower. The dividend yield is 3.10%. The compounding effect will be nice with VNQ. The third ETF is VGT, the Vanguard Information Technology ETF. The actual context may be not in favor of VGT, but you cannot go wrong investing in the technology sector, especially if you're here for many years. VGT is tracking the MSCI US Investable Market Information Technology Index. That means with this ETF you will track companies in the information technology sector. With VGT your money will be spread between 394 companies in the information technology. The 10-year average return is 18.24%, but keep in mind the current situation. VGT have low fees, only 0.10% per year. It's also a good add to your portfolio. The top 8 holdings in VGT are Apple, Microsoft, Nvidia, Visa, MasterCard, Broadcom, Adobe, and Accenture. As you can see, some solid companies in this ETF. The dividend yield is only 0.87%, but you're investing in for the growth with this ETF. The last one ETF is not from Vanguard but from Schwab, and it's SCHD, the Schwab US Dividend Equity ETF. This one is for the dividend lover. And the goal of SCHD is to track the performance of high dividend yielding stocks in the Dow Jones US Dividend 100 Index. Your money will be invested between 104 companies that have a solid record of paying dividends. The 10-year average return is 13.33%. And finally, the expense ratio is 0.06%. The top 8 holdings of SCHD are Merck & Co., PepsiCo, Amgen, Coca-Cola, IBM, Verizon, Pfizer, and Home Depot. The dividend yield is 2.83% per year with solid companies. If you like passive income, you can't go wrong with SCHD in your portfolio. I hope you enjoyed the video. Don't forget to smash the like button and subscribe to the channel.